Hello and welcome to Boston Common Asset Management's quarterly update webinar for the first quarter of 2021, discussing our international equity and emerging markets equity strategies. I'm Kristen Jenko, Head of Client Service at Boston Common, and I'll be your host today. First, a very warm welcome, as always, and a thank you to our clients and partners who have taken the time to join us today. You all make our work possible, and we're grateful to work on your behalf, activating your capital for financial return and positive social and environmental change. So thank you again. It's my pleasure to introduce our speakers today: Boston Common CEO, Alison McDonald; Praveen Abichandani, Director of Securities Research and Portfolio Manager for Boston Common's International Equity Strategies; and Liz Su, Global Equity Analyst and Portfolio Manager of the firm's Emerging Market Strategies. Welcome, Ali, Praveen, and Liz. Over the next 30 to 45 minutes, we'll touch on several topics. Ali will provide a brief update on the firm and share some of the exciting things that have been happening here at Boston Common in the first quarter. Praveen will walk us through the international portfolio, discussing performance drivers, positioning, and portfolio strategy, highlighting our approach, of course, to seeking companies that are providing solutions to the world's challenges. And similarly, Liz will provide an update on the emerging market strategy. Along the way, I'll share a few brief highlights of our shareowner engagement work and firm milestones from the quarter, and then we'll finish up with a brief Q&A session. We will be addressing questions throughout the discussion, and you can submit them by clicking on Q&A. We'll also answer as many questions as we can during our allotted time, either live or through the Q&A chat. And our video is paused now to focus on the slide presentation, but then we'll be sharing video again during the Q&A session. So now, without further ado, I'd like to turn the floor over to Ali to share some of the exciting updates that have happened in the first quarter at Boston Common.
Great. And thank you so much, Kristen. And I'd like to echo Kristen's comments and thank everyone for their ongoing partnership and confidence in Boston Common that allows us to do what we do every day. And speaking of doing what we do every day, we are all still doing that remotely from home. Our plan is to phase back into the office slowly this summer and more significantly in the fall. But what we've learned, I think, as many of you have learned in your own business, is that we've adjusted well to remote work, and we recognize how lucky we are that we're able to continue to work efficiently and effectively on your behalf during this period. In fact, working effectively, we've had one of the best years, as you know, in 2020, we had one of the best years in terms of performance, new business, and AUM growth in our company's history. And we just finished our best quarter by far in terms of new business and AUM growth. What I'd like to do is cover a few things today. First, I will talk about that AUM and the AUM mentioned here on the slide. And then I'll discuss the transaction that we completed this quarter with our new equity partner, AMG. And lastly, I'll talk a little bit about how we're positioning our business to scale for the great growth that we are experiencing. So as you can see on the slide, our current AUM sits today at $5.3 billion in assets under management. Just to provide some context for those that may not be following our AUM as closely as we are, we were $2.8 billion in January of 2020 and $3.9 billion this January in 2021. Again, as you heard, 2020 was a record-breaking year on many fronts. And then we just added $1.2 billion in assets in the first quarter of this year. But let me provide some context. The increase in 2020 and over the last 15 months was due to really strong performance, strong new business and some large mandates, great market growth, and very little client attrition. We also have been more recognized as of late for our minority or emerging manager status due to a general increase, I think, in investors and allocators looking for more diverse managers. Specifically, I should point out, though, that this $1.2 billion or so in assets that we added in Q1 2021, of that, $900 million or so is a sub-advisory mandate that we just received from our new partner, AMG. I make note of this in that this fund that we took over was managed as a US all-cap growth style, and we're changing the mandate to our global impact strategy. So we expect perhaps about half of these assets could leave. So please don't be alarmed if next quarter we're talking about a slight decline in our AUM. But even without the $900 million, we still had a very strong first quarter 2021, and I think one of the strongest in the company's history. Needless to say, we are very pleased in the growth in assets and the opportunity that you've all been bringing us. So speaking of AMG, I think it's important for everyone to understand why we did this deal and what it means to Boston Common in the long term. First, many of you are aware that other small pioneers in the ESG business and other boutiques have been purchased or combined with other asset managers or other publicly traded companies in the last 5 years. And we've certainly had our fair share of interest in our business. In fact, at the beginning of 2020, we had a company seriously seek to buy 100% of our company. And as a management team and board, we did due diligence and some soul searching. And we decided that we didn't feel as Boston Common that we would be able to do what we do and be our authentic selves and not have conflict if we were to be purchased by a publicly traded company that has other businesses besides ESG and impact investing. And so we made the decision that we were going to do what we needed to do to stay independent. Post that, we started conversations with AMG, and we were very impressed by the management and the team members from AMG, and we were impressed by their ability or their willingness to be flexible in building a partnership with us. We talked about being Boston Common and staying authentic and true to ourselves and staying independent. And we found out from AMG and we found out from AMG affiliates that this is core to their culture, that they are intentionally work with boutiques and let the management run the company and leave them independent to do what they need to do. Yet they provide consultation, advisory, and a sounding board on a regular basis. So we were excited to hear about this flexibility from AMG. As many of you know, Rosemont Partners owned 20% of Boston Common, and we were 80% employee owned. AMG was willing to put together an opportunity for us to buy back 5% of our stock and to take out Rosemont Partners. Rosemont had us in a private equity fund that was coming due in 2023. And at that point, there would have been a not so insignificant payment that Boston Common would have had to make. And so by taking out Rosemont Partners and being permanent equity, AMG took that opportunity for us to have to pay Rosemont off the table. So after doing the deal with AMG, we end up at Boston Common is 85% employee owned and 54% women owned. And AMG owns now 15%. So we are not only excited to have this great partner who is a trusted advisor and consultant to us, but AMG also provides us opportunities for global distribution. And this was something that was in our growth plan to hire and create more of a distribution opportunity for Boston Common. And by doing this deal with AMG, we got cost-effective, scalable way of offering distribution. And then last but not least, they offered us an opportunity for sub-advisory. And so the aforementioned 900 million plus Global Impact Strategy Mutual Fund was also part of that deal. So what doesn't usually happen in three-way deals in financial services is that all three partners or all three parties walked away happy. Rosemont got fairly paid for its investment in Boston Common. AMG had an affiliate that fits with their new strategic plan and outlook. And Boston Common can continue to manage our business in the same client-centric, people and planet-centric and authentic way we always have. So this, I think, is very good news for Boston Common in the long term. And then the last thing I wanted to talk about before I go to the performance slide is how we're thinking about this growth and how we're preparing the firm for this increase in assets and activity. And to be clear, this isn't a reflexive or reactive stance to the significant increase in business. Our strategic priorities in 2020 started with the concept of scaling and strategic growth and creating efficiencies and capacity for this growth. The most important thing that we keep in focus is that we are able to continue to deliver a high level of customized client service for our clients and deliver the boutique experience Boston Common is known for. We do not want to give up what truly makes us unique and authentic for the sake of new AUM. And we want to make sure we're servicing the business in the most effective way for you all, maybe even improve some aspects of this. So not only are we working on creating efficiencies, we are bringing on new technology, we're bringing on Salesforce and other tech platforms to aid us in content management, trading, and reporting. And of course, we're hiring more people in key roles at the firm. On the new hire front, and you can see it on our next slide, we've added a great analyst to our operations team, Kathy Young, who comes to us from State Street. And as you can see on this integrated ESG investment team slide, we've promoted Jonathan Starr, who has been with the firm for 3 years. We've promoted him to research associate from our client service department, where he is a standout with data and reporting, and he's currently completing his CFA. And then lastly, we just announced Leah Torino, who worked as an ESG research analyst at Boston Common 5 years ago and has been spending the last several years at UBS. We brought her back, we brought her home in a newly created internal and client-facing role as the head of ESG integration. We continue to post new roles, and we appreciate any candidate leads that you have provided for us and offer you to continue to do so. So my last responsibility for today's webinar is to discuss the performance slide. And there it is. And I told the team I only wanted to discuss the performance slide when this is what the performance looks like. I'm just kidding. But something of note is that our performance, as you know, was very, very strong across the board, significant outperformance in 2020 across the board. And of note in Q1 2021 is that we gave some of that outperformance back. But as you all know, we are long-term investors, active investors with focusing on a 3 to 5 year investment time horizon. And you'll hear that from some of my colleagues today. And then lastly, before I hand it back to Kristen, I wanted to mention something that based on feedback from a lot of our consultants and our clients and the increased interest in our emerging markets strategy, we are going to be launching at the end of May an emerging markets mutual fund. So that is on the things to come in this quarter. So I look forward to taking any questions you may have at the end of the webinar, and I thank you again for your continued support of Boston Common.
Thanks so much, Ali. I'd like to turn it over now to Praveen for a deeper look at the international strategy and some of the drivers of performance for the quarter.
Sure. Thanks, Kristen. Hello, everyone. Happy spring. I'm glad to provide an update on the international strategy, our flagship product benchmark to the MSCI EAFE. The PM team is Corne Beemans, Matt Zalosh, and myself, supported by our esteemed ESG and investment research teams. We strive to find great ESG companies and those going from good to great with sustainable growth, strong balance sheets, and attractive relative valuation. We are long-term focused with 3 to 5 year horizon, pursue a low turnover, and look for margin of safety. The EAFE regions give us a wide range of large cap, ESG-friendly companies to evaluate, especially in Northern Europe. Our international portfolio was flat for the quarter versus the EAFE index up 3.5%. While we underperformed on the quarter, our 1, 3, 5 year long-term relative performance is still strong. 1 year return up 47% and 3 year annualized 8.6% are about 2.5 percentage points ahead of the index. On the quarter itself, the bright side is we didn't lose money. A couple of points on the market backdrop. While the index rose 3.5% in US dollars, it was up 7.6% in local currencies. The US dollar and UK pound strengthened, presumably, as the two countries lead in vaccinations. Global liquidity growth is arguably the strongest since World War II, driven by policymakers' stimulus efforts around the globe. This has driven goods demand to be the strongest in decades, and with mobility returning, boosted commodity prices, including oil. This in turn drove inflation expectations and long-term interest rates higher, not the ideal environment for our quality approach. I'll use the next several slides to explain the transitory factors that caused the underperformance and why that's quite unlikely to persist. So starting with the sector attribution. The first quarter oil price increase was the strongest in decades. Energy was the best performing sector, as you can see in the middle table, or the second table, up 11%, followed by financials up 10%. Discretionary industrials and materials also did well, while defensives, healthcare, staples, and utilities posted negative returns. Our international strategy lagged for three primary reasons. First, rising rates pressured high-quality growth holdings, especially in technology and consumer discretionary sectors, while helping depressed cyclicals in the index. Second, we were underweight traditional internal combustion engine autos. Third, renewable energy lagged while conventional energy outperformed. Shinny Solar, Chinese manufacturer of solar glass, which comes under tech, was a leading detractor along with Danish wind energy stocks. In tech, we lost 1% point of relative performance while losing about 80 bips in discretionary. In the consumer discretionary sector, traditional automakers outperformed, especially in Europe, while our French auto system supplier Valeo lagged. Staples and industrials were also major detractors, nearly half a percentage point each of relative performance. Stock selection was the primary culprit. On the positive side, our financials outperformed, while communication services was break-even on a relative basis. Next slide, please. Now looking at the regional attribution. By region, Japan was the most challenging, where our stock selection penalty was over 1 percentage point, driven by personal care company Kao, lens specialist Hoya, tech stocks, TDK, and Keyence. This was followed by underperformance in Europe, UK, and emerging markets, costing us between 40 to 80 bips per region. As noted earlier, Shinny Solar in China, Ørsted and Vestas wind energy stocks in Denmark. These are renewable energy leaders which underperformed this quarter after a great 2020. Adidas in discretionary was hurt as China Xinjiang cotton controversy surged. European staples Kerry Group and Unilever lagged. We continue to like most of these names on a 3-year basis, especially our renewable energy names. At a median of 15 times EV to EBITDA, our renewable energy stocks are highly likely to be major beneficiaries of net zero emission pledges throughout the world, starting with EU, which is the leader. We have added to several of these names on weakness. On the positive side, EU financials ING Group, AXA Insurance, along with Orix in Japan were 3 of the top 10 performers. Also part of the top 10 were industrials Assa Abloy and Atlas Copco in Sweden, Kion in Germany, and Recruit in Japan. Ironically, within tech, we had 2 semiconductor holdings. In Europe, ASM Lithography and Infineon, which outperformed. Now looking at portfolio activity. I will primarily comment on, can we go back one slide, please? Slide 9. I will primarily comment on new and closed positions. In Asia Pacific, we bought OCBC, Overseas China Banking Corp, a high quality Singapore bank with exposure to emerging Asia. Singapore's banking market is attractive based on the country's political and legal stability and its position as an Asian trading hub. OCBC has strong wealth management and life insurance businesses that complement its lending operations. Stock is attractively valued at 1x book and 4% dividend yield. In Sweden, we acquired Volvo Trucks, which is the third largest truck manufacturer in the developed world in a relatively consolidated industry. Volvo has proprietary heavy diesel engine technology for emissions reduction. It is valued at 14.5 times forward PE with a strong balance sheet which has net cash. Company has medium duty battery electric trucks already available in Europe. Volvo also has supplied battery electric buses to cities in Sweden for several years. Two long-term winners we sold in tech for valuation reasons were ASM Lithography and Keyence at over 50 times forward PE, where EPS is not quite depressed. We added to several discretionary names: Alibaba in China, Barrett Housing in the UK, Adidas and Valeo in Europe. Other adds were in financials, AXA Insurance in Europe, Macquarie in Australia. We trimmed some defensive holdings, Nippon Tel, Roche Pharma. So on a net basis, we added to discretionary, financials, and industrials, while reducing tech and staples. By region, our weight went up in Asia Pacific and declined in Japan. These were all bottom-up driven adds and trims in consultation with the analysts. Next slide, please. On the outlook, strong liquidity support from policymakers, along with increased vaccination rates and pent-up services demand, support a strong cyclical rebound. At the same time, secular trends such as aging demographics and greater automation suggest scarce long-term growth in a world of low interest rates. Our portfolios are balanced with overweight in technology, financials, and industrials, while underweight in discretionary and commodities. In industrials particularly, we have several ESG leaders which have been long-term holdings. Looking at the regions, EU, Eurozone, after a few fumbles, has picked up vaccination rates and expects to have 70% of the population inoculated by the fall. On a longer term basis, EU has allocated nearly 2 trillion euros over the next decade to combating climate change, which would allow solutions companies to prosper. We have strong exposure to companies that stand to benefit. On Japan, while the headline economic numbers look weak, there are global export-oriented leaders we own in the consumer sector particularly. Finally, emerging markets, which is a quite varied universe from South Korea and Taiwan, on par with developed markets, to Brazil, India, and South Africa on the other end, which lag hugely in dealing with the pandemic so far. Poorer countries need G10 help as we strive towards global inoculation. Virus variants in emerging markets and other places remain a worldwide threat. Our portfolio is slightly more expensive relative to the index at 19 times, while the index is 18 times PE. but higher expected EPS growth 3 years annualized at 10% versus 7.5% for the index. Our portfolio is also lower beta and lower EPS variability. The active share is about 84% and tracking error 3.5 to 4% annually. Our top 10 holdings comprise a quarter of the portfolio and are well diversified. The top 4 are financials. In this box, you can see our portfolio has 84% fewer emissions and 65% lower carbon intensity. And you can see our EM country weights by exposure in the smaller box in the right-hand side. So we continue to be overweight financials, about 300 basis points, along with industrials, and underweight discretionary and materials. And by region, about half our weight is Eurozone, which is slightly overweight, and emerging markets are quite overweight, even though the absolute level has a small proportion. Next slide, please. Our portfolio company highlight is Japanese financial services conglomerate ORIX. This is a long-term holding. Company has emphasized financing green initiatives, starting with solar, and has grown its renewables portfolio to one of the largest in Japan. We expect it to benefit in the global recovery with improving credit quality in its aircraft and auto leasing segments and hospitality lines, given its broad Asia-Pacific presence. ORIX also has a meaningful overseas asset management segment. Stock is quite inexpensive relative to global peers at 0.8 times book value and 4% dividend yield, which they maintained in the downturn. ORIX is amongst few Japanese financials with history of stock buybacks. Our engagement team has worked with them last 5 years on climate-related disclosures. With that, I wish everyone a safe vaccination, and back to Kristen.
Thank you, Praveen. Quickly before we turn it over to Liz to give an update on the emerging market strategy, I will share a few notable updates on shareowner engagement that apply to both strategies as well as some firm level milestones. So this quarter, we joined the Net Zero Asset Managers Initiative, and we have committed to net zero portfolio emissions and a 1.5 degree scenario alignment by 2050. And setting these net zero goals by 2050 is also a key engagement ask, particularly for the financial sector under our Banking on a Low Carbon Future initiative. And it's also an example of how we like to walk our talk, as we say, expecting the same standards of ourselves as we also engage companies to improve their ESG profiles. In 2020, we actively engaged our emerging markets and Asian holdings on advancing ESG oversight, management, and disclosure, and also advocating for those companies to adopt net zero carbon goals in countries like China and Japan. We have an ongoing focus on COVID-19 and systemic racism, and continue to address these dual crises in all of our company engagements. As a firm, we've been able to withdraw several shareholder proposals filed during the season with positive outcomes. We joined the Investor Alliance on Human Rights in leading outreach to apparel and technology companies on addressing human rights abuses in the Xinjiang Uyghur Autonomous Region. And as a result, Adidas and other holdings across strategies no longer have business relationships in the region. And lastly, we have continued our dialogue with Bank Rakyat on addressing deforestation risk related to lending to commodities producers, including palm oil. Let's turn now to Liz and the emerging markets portfolio. Liz, can you share a deeper look at some of the drivers of performance for the quarter?
Great, thank you, Kristen. and thank you all for joining us this afternoon. I wanted to start by making a few comments on the recent rotation we are seeing in the market and highlight a few drivers behind our first quarter results. Then I'll provide some details on portfolio actions and positioning. Emerging market started the year 2021 very strong, but investor sentiment quickly shifted more towards inflation than growth in this global reopening debate. This quarter, our portfolio returned 1.5%, modestly trailing the market return of 2.3%. Two quick callouts of driver here. First, rising commodity prices and an increase in long-term interest rates pressured some of our high-quality growth holdings, while boosted more depressed cyclical stocks. And secondly, our renewable energy holdings, which typically benefit from rising commodity prices, actually declined. As you heard from me last quarter, we have started taking profits on some of the strong performing sustainability names since second half of last year, but our portfolio remains invested in this secular growth area given our positive long-term outlook. We are long-term investors, yet we are active in our approach. With the current market rotation, we start to see opportunities emerging to add back some of our high conviction stocks. We remain very focused in our approach, looking for high quality businesses that can provide solutions to many of the environmental and social challenges we all face today. On a one-year basis, our portfolio returned 64% on net basis, comfortably outperforming the benchmark of 58%. Now, let's take a closer look at the first quarter, which is on the next slide. Not surprisingly, cyclical sectors in general perform better as economic recovery gathers momentum. Materials was the best performing sector, returning 9%. Financials and real estate also did quite well, while defensive sector stables and healthcare lagged. Not only enough the outperforming materials sector detracted, but also our materials holding such as EV battery manufacturer LG Chem and sustainable packaging company Mondi did not keep up with their more commodity-oriented peers. In the tech sector, as you can see, is also a detractor. Solar company Xinyi and the digital payment company PagSeguro sold off as investors rotated away from recent winners. Other notable detractors include Itaú Bank in Brazil and Credicorp in Peru, where both countries still struggled with rising COVID cases. So what has helped? Stock selection in consumer discretionary was positive. Our investment in the travel space had paid off. Ctrip in China was strong on the back of recovering travel demands. Taiwan iCompany Giant saw its first quarter sales up 55%. And this is a solution company in the sustainable transportation space with very attractive growth outlook. Our industrial holdings returned 17%, better than the index return of 2.7%. Weichai Power, which is China's largest diesel engine company with technology leadership in energy efficient engines, benefit from improving industrial demands and optimism around its hydrogen fuel developments. Our stock selection in the defensive healthcare also helped. Now, let's take a look at from a regional point of view, which is on the next slide. As you can see here, the tailwinds of a strong commodity price will not feel the same across regions. Africa and Middle East regions was up more than 10%, while Latin America actually declined 5.3%. Brazil was the primary detractor in Latin America this quarter. Our positive stock selection in Asia have helped. In India, we own Voltas, which is a leading air conditioning and engineering services company, and HDFC, one of India's largest private bank with a strong ROE, have both outperformed on very solid results. Capital Bank in Thailand was also one of the top contributors. Our stock selection in China and Taiwan also added value. Now let's move on to the next page. I wanted to share with you some of the portfolio actions we undertook this quarter. We initiated position in Longfeng, a high quality real estate company in China. Property demands actually remain very strong in China, driven by continued urbanization, while government recently enacted a series of deleveraging regulations. We believe this dynamic should benefit industry leaders such as Longfeng, who has a very strong balance sheet, but also exhibited positive ESG momentum. Through our in-depth ESG work, we noted that the management recently launched an ESG committee at the board level and also made significant improvement in green building initiatives. We also added into attractively valued financials such as Ping An, an insurance company in China. South Korea Telecom, or SK Telecom, is another ad where our deep fundamental work strengthened our conviction in terms of its undervalued assets and potential re-rating from corporate restructuring. And as you can see, our approach is to focus on high quality businesses that are misunderstood by the market and have ESG momentum that we believe is underappreciated. And to finance these purchases, we sold Raia Drogasia, a drugstore operator in Brazil. The stock is trading at 45 price to earnings, which we believe is quite full, especially in light of the challenging macro environment in Brazil. We have also reduced some of the strong performing tech names such as Yandex and some EV exposures early in the quarter after strong returns in 2020. Next, outlook. Well, COVID containment is still a dominant driver for emerging market outlook, and the vaccination progress really varied across the regions, as Praveen has already mentioned, from China and Taiwan on one end and Brazil on the other. Overall, however, emerging market economic recovery has exceeded expectations. This faster than expected recovery has stirred investors' fear of sustained inflation that would lead to preemptive policy tightening. In our view, cyclical factors, including base effects, higher commodity and food prices, and supply chain disruptions could push near-term headline inflation higher, but these are likely to be transitory, thus not posing a major threat to the dovish stance of the core central banks, including the Fed. Therefore, we expect modest upward pressure on the interest rate, and we believe that strong stimulus measures and a more synchronized global recovery as vaccination rates improve outside of the US should support a robust earnings recovery in emerging market. Meanwhile, emerging market is still trading at a noticeable discount to developed market with expected earning growth of 50% over the next 2 years. Looking at regions, China recovered earlier than other countries, while inflation actually remains quite subdued, leaving plenty room for policy maneuver. We expect continued fiscal stimulus from the government, focusing on long-term sustainability investment aligned with its recent 5-year plan, which will have some details in a later slide. Taiwan's growth outlook remains very solid, supported by a booming semiconductor industry, which we have an overweight to, and domestic capex spending as companies move production back to Taiwan. In Brazil, near-term outlook is clouded by renewed health crisis and political uncertainties. We moderate our expectations, but still see global demand recovery and commodity prices as potential tailwinds. Next slide, please. So here you see a graphic representation of our current positioning. And given our expectation of modest interest rate rise and strong earnings recovery, we have added into interest rate sensitive sectors such as financials and real estate, while reduced some of the overweight in consumer staples. Overall, our portfolio remains quite balanced with overweight in cyclical financials, tech, and consumer discretionary, offset by modest overweight in healthcare and consumer staples. Our portfolio continues to gear towards domestic demands in emerging markets, with 45% of the portfolio invested in tech and consumer discretionary. We continue to believe that the next leg of growth in emerging market is driven by consumption, services, technology, and innovation, where strong ESG practices can add competitive advantages. From a regional point of view, we continue to overweight South and Southeast Asia, where countries such as Indonesia and Thailand are well positioned to benefit from the global economic recovery, although we are mindful of the risk of a new COVID outbreak. We also have a modest overweight in Latin America and an underweight in East Asia, mostly in China, but overweight tech-heavy South Korea and Taiwan. And because of our approach of looking for high-quality business through the lens of ESG, our portfolio is slightly more expensive than the index, but with higher expected growth, better ROE, and lower earnings variability. This should be a rather consistent characteristics you can expect from our portfolios. Next, and this will be my last slide, and it's a little bit busy, but as we all know, China has committed to achieve peak carbon emission before 2030 and carbon neutral by 2060. Achieving these ambitious goals requires significant investment in a low carbon and more energy efficient economy. And this chart shows you the long history of China's energy mix all the way from 1965. Coal consumption, which accounts for 80% of the emission and is represented by the darkest blue area, actually peaked around 2013. While renewable energy, which are the different shades of green here, are taking more shares. In fact, over the past 10 years, non-fossil fuel energy share have been almost doubled to 15%. And based on the recently announced 14th five-year plan, government targets to further increase this share to 20% by the year 2025, which is 5 years earlier than its original plan. We expect more detailed investment plans to roll out in 2021 and beyond. And we have been active in position our portfolio to benefit from these sustainability growth opportunities. Pinyi Solar in renewable energy, Delta Electronics in building energy efficiency, Giant in sustainable transportation are just a few of the examples that we highlighted on this page. And with that, I want to pause and hand it back to Kristen.
Thank you, Liz. So now I'd like to open the discussion for a short Q&A, and we'll turn our video back on, stop the screen share. We have a few questions, and maybe we can wrap up a little early and give you all a few minutes back in your day. So let's start with Liz. Liz, you were just speaking about China. Can you elaborate a little bit more on the risks and drivers of emerging markets performance, particularly for China?
Great. Thanks for that question, Kristen. Maybe let me start with risks first, because that's probably what tends to keep me up at night. Well, COVID containment is first and foremost clearly on top of mind in terms of risk. And I would also mention geopolitical tension between US and China. And so far, Biden administration is continuing a hardline stance with China, but with a more multilateral approach. Recently, we are seeing some tensions on human rights issues in Xinjiang, and multinational companies have to navigate these complex and sensitive issues. I guess positive news is that just this week, US and China just made a joint statement on collaborating on climate change, with China and US being the top two carbon emission producers globally. We do need the two nations to come together, and we hope to see more. Another risk I would mention is the populism in Latin America. With COVID hurting the lower income population the most, we are seeing social unrest lately in countries such as Chile and Peru. In terms of opportunities, there are many exciting long-term growth areas, and I'll just perhaps highlight a few. First is the rising middle class. China is a great example. China is well on its way to a consumption-driven economy. And just to give you some data point in terms of the size, in 2007, China's retail was 1.2 trillion, or 27% of the size of US. In 2019, which is just before COVID, China's retail sale is 5.9 trillion, about 95% of the size of US. And this vast addressable market provides many exciting stock picking opportunities. And second area I would mention is the green investment, as we touch upon China, but both China and South Korea have made commitment to carbon neutral. And we expect significant investment in alternative energy and green infrastructure in the years to come. And we'll say the third thing I would mention is technology and innovation, and that's really where we see the growth of EM driver is shifting to. And if you take a closer look at China's most recent 5-year plan, the government target to increase R&D spending by 7% per annum minimum. And rather than investing in roads and bridges, China really wants to shift their focus to invest in 5G, digitization, manufacturing upgrade. And I want to just make a note that digitalization is actually a great way to reduce your manufacturing carbon footprint. So that is very consistent with China's industrial policy, which is investing in a more sustainable growth.
Thanks so much, Liz. We have a question from a listener specifically around coal plants in China. Any thoughts to share on that with the sustainable development you're seeing there?
Yeah, no, that's a great question. And that's really something we are monitoring closely. As I mentioned, coal accounts for 80% of the carbon emission. And as the absolute amount or the consumption of coal, it has peaked around 2013, but the economy is still growing and the consumption of coal is still rising. And also what's important to notice is as China, the Belt and Road Initiative, what China is in terms of investing in coal in other parts of emerging markets. So that's definitely something we are monitoring very closely. And the offsetting factor to that is what I've mentioned in terms of very aggressive investment in renewable energy, solar, wind, and this, again, this is very consistent with China's industrial policy, where it's already a global leader in solar panel production, almost 70% of the market share.
Great, thanks so much. And now a question for Praveen. Europe has been running behind other countries on the vaccination rollout, and we're seeing more countries, having shutdowns. And so how do you see the recovery?
Yeah, thanks, Kristen. You are correct. Per the WHO, Eurozone vaccination rate so far is about a third of US and UK, as the Eurozone has had several missteps in procurement and rollout. Various EU countries suspended the Oxford AstraZeneca vaccine due to rare clotting events, and France, Germany, Holland, Italy, etc. have had sporadic lockdowns, curfews, and dangerously low ICU availability. So the countries have made adjustments, administering the AstraZeneca vaccine to ages 55 plus. The good news is the J&J single shot rollout resumed in Europe today. And with much greater availability as the US moves along much further of Pfizer and Moderna jabs, that should be more available again in Europe. And they also have in Germany a strong pipeline candidate, CureVac, and all these are likely to help Europe catch up in a few months. So they're likely to get on the same path as the US and UK with a few months lag at most. And as noted earlier, the variants remain the biggest risk going forward for the whole world, not just the Eurozone.
Great, thanks, Praveen.
Sure, my pleasure.
I think let's give our listeners back a few more minutes of their day, and we'll wrap up from here. On behalf of Ali, Praveen, and Liz, and all of us here at Boston Common, I'd like to thank you for joining us today. As always, we greatly value the work you entrust us to do on your behalf, and we invite you to reach out directly with any questions. Wishing you good health, continued safety, and a very happy Earth Day tomorrow. And we're looking forward to speaking with you and hopefully having the opportunity to see you all again in person very soon. Thank you.